we sort of have the impression that the regulators think it would be just as well if we didn't survive. You know, we are probably well suited to get money out in the markets faster than anybody, and happy to do it. But we have regulators taking such a draconian approach to our loan portfolios, often arbitrary, often not really supported by the facts, really driven by fear. If I remember the 90s one more time, I swear I'm going to scream. I do remember the 90s. I was there. It seems that very much cross purposes, and you know, right now, you know, we're hoarding capital for that reason, even though we're still making loans. So my question is, have you had conversations with the regulators at the highest level so that you're all kind of working in the same direction? Because it doesn't seem like you are.
Well, no, thank you for asking the question, but we absolutely have numerous conversations with the regulators at the highest levels. First of all, just speaking to the TARP, our Financial Stability Oversight Board, you know, is chaired by Chairman Bernanke, in addition to Chris Cox and Steve Preston and Jim Lockhart. We work very closely with John Dugan at the OCC, John Rich, and Sheila Bair. So there's great collaboration among the regulators and with Treasury. It's interesting that I'm candidly surprised to hear you say that, because it's usually the regulators who are saying Treasury. They were the ones calling Treasury saying, we got to get the private bank term sheet out. We got to get it out. And we said, we agree with you. We heard you. We're working on it. We think it's essential because some of our community banks are some of our healthiest banks in the country. And some of them are in the best position to step up and extend credit in their communities. So we think it's absolutely vital. I'm sorry or disappointed to hear your comment. I'm sure you're right. But I can just tell you in Washington, within the TARP, within the administration, and within the regulatory community, people are very focused on community banks. And again, we want banks of all sizes to participate in the program and to extend credit. That's why I made the comment in my remarks about the biggest investment was $25 billion. The smallest investment was $9 million. Both of them were equally important. Other questions, please.
Thank you, Mr. Secretary. Some might say that enough is enough, that there's been too many programs, and that investors have thrown their hands up and said, we don't know what's going to happen next, and so we're going home. For the last 5 weeks in the capital markets, the bid is gone. There's no trading of CMBS, which is most relevant to most of the people in this room. There's no trading of ABS. There's no trading of cards, auto, students, nothing. I mean, no bid, no bid. And that has come about because each time our investors have gone for the falling knife, they've been lacerated. And they've been lacerated because they didn't know what program was coming next. And I think most of our investors now are just saying, look, we're going to wait. The psychology of our investors today is, let's wait for the next program. Right? How are you and the Treasury going to go at that problem that another program is what our investors are looking at or waiting for today, as opposed to some sort of continued focus on the banks themselves? I mean, we would say that the propping up of the banks and the capital purchase program is a phenomenal use of the TARP money. It helps very much those banks put actual dollars back in. But at the same time, another purchase program here and another purchase program there, it's very, very difficult for the buyers to know what's next.
So I appreciate your comment. We share some of those concerns. I mean, government intervention, first of all, was clearly not our first choice. But we felt it was necessary. I hope we would all agree that it was necessary given what we're facing. And it always has unintended consequences. You know, in some sense, we're solving one part of the credit markets, and we feel good about that, and then the fire springs up over here. And then we have to run over here and try to put out the fire. And it keeps happening. Now, look at some of the markets you just talked about, though. Credit card securitization, auto loan securitization. These markets have been functioning quite well through the credit crisis. They didn't stop working because of a government program. There was no government program on credit card securitization or auto loan securitization, and the markets froze. And so as policymakers, we're faced with a choice. Do we just let that freeze, which will have profound macroeconomic implications? You know, if consumers can't afford to buy a car because they can't get a car loan, what used to be a 6% car loan, now it's a 14% car loan. That's a real problem for the economy. Same thing with credit cards to fund very basic purchases. If people can't get basic credit. And so we're always faced with a choice. do we step in or not, we always try to weigh the costs and risks of stepping in versus the costs and risks of not stepping in. We understand that there's confusion because there are additional programs coming, but hard choices are easy to make when you really don't have a choice. You know, when the consequences of inaction are so grave, we have to step in. Again, it's not something that we want to do. We want to see the credit crisis run its course, see our institutions healthy, extending credit, and some return to normalcy. But we're not there yet. And, you know, my bias is, you know, over the last 15 months or 18 months of the credit crisis, it's only gotten deeper. You know, it's only gotten more severe. And I would rather be on our front foot, going after the problem aggressively with new programs, trying to be creative, trying new things, rather than just sitting back and saying, let's just let it happen and see what happens, see if the system collapses. I've got time for one more question. Or we can call that the last question. Okay, I'm happy to do that. Thank you all very much. I really appreciate it.